And welcome to another Lumi Financial Corner. With us once again, Michael Zaremsky, head of U.S. Private Banking, Bank Lumi USA, member of Investment Committee for Lumi Investment Services. Michael, great to have you back in. How you doing?
Doing well, Zev. Thank you for having me.
Thanks for joining us again. Last time you were on, you spoke about inflation, and you said, yes, it's an issue, but we shouldn't be then overly concerned. Since our last discussion, I keep on hearing, whether I open up a newspaper or a television station, open a radio program, keep hearing inflation is back, it's terrible, it's this and that. Are they correct that they're trying to whip us into a frenzy, or do we have to be as concerned as what we're seeing in the media about inflation?
It's a great question, and I think it's still one of the most relevant questions of the day for capital markets. First off, let me state that the views expressed on the call are my views, not necessarily those of the bank or the broker-dealer. And having said that, my opinion, I think that as I've repeated many times on these conversations with you, the media loves a negative story, and I think that the fear and the negativity is always a great lead story. However, I think we really need to look at data and look at fact. And I think also we really need to look for guidance from the Fed. And whether we agree with the Fed or disagree with the Fed, ultimately the Fed is the arbiter on making the judgment of, what is happening with inflation. And right now the Fed is basically telling us that the current inflation that we're seeing is just transitory. So what do they mean by transitory? And essentially what they're saying is that the economy was in a really bad spot a year ago. A lot of things shut down. And as we've continued to recover from this pandemic-induced recession and pandemic-induced lockdowns, there's a big surge right now in demand for almost everything. And when you have a surge in demand for everything, particularly when supply was locked down, you run into a situation where prices rise. And we're seeing that price rise. However, what the Fed is saying is that as supply comes back on stream, as factories, manufacturing facilities, service workers, as everybody else comes back, you're going to see everything normalize. And the inflation that we're seeing right now, this quick shoot up in pricing, will abate and move on, and it'll just be transitory, meaning that this too shall pass. So the challenge with it is the Fed's not really defined what transitory is, so we don't know if it's a week, a month, a quarter, or through the year end, or who knows. But having said that, they are the judge, jury, and arbiter of what transitory is. So from that standpoint, I think we need to take the Fed at their word. And I think anecdotally, we can also see some of this in the data. First and foremost, when we look at the 10-year U.S. Treasury market, which is typically one of the leading measures of what we're looking for inflation, it has been largely range-bound. It has been hovering between about 150 basis points to about 175 basis points, or possibly even tighter, basically since March. So last week there was a lot of concerns about growing inflation, and the 10-year rose up to kind of the upper end of that range. And then all of a sudden this week, when some of the economic data came in a little bit differently, things backed off a bit, and now we're kind of right back in the middle of that range. So again, I think that we can look at the markets to try to keep an assessment on it, and the Fed is basically telling us, don't panic, things will be okay.
So basically what you're saying is because there's a shortage of goods, factories are not operating at full capacity, it's supply and demand. So since there's more demand than supply, so prices go up, and when things get back to normal, it will reverse.
There's definitely a big element of that, and again, I say when we look at the data, we also see that, and I know a lot of people in the area are very wrapped up and concerned about real estate and the housing and the building industries. And one of the big headline stories is about the rising cost of plywood and 2x4s, etc., building supplies. You have started to see a slowdown a little bit in some of the new construction, and essentially it's a reaction to the price. So as prices rise, things tend to slow down, and I think we're seeing that. And again, this is part of this transitory issue. The other thing that I would also kind of highlight is, even if we do see some inflation, which the Fed is happy to get, and the Fed's been trying to drive us towards a 2% inflation, what does that really mean? And when we look at the equity markets right now, despite all the fear, despite all the kind of hysteria, we're looking at the S&P 500, we're looking at the Dow Jones as both basically, within 1% or so of their all-time highs. The NASDAQ, which had been hit pretty hard over the last couple of weeks as thematic tech stocks took a hit because of fears of rising interest rates, and small cap stocks are still, within about 5 percentage points of their all-time highs. So again, as negative as some of the news flow has been and as bad as some of the concerns have been, we're looking at markets that still remain rather robust. And today is one of those days where I've actually made it back into the New York City office for the first time in a while. It's about my third trip in the last few weeks. And you're definitely starting to see the recovery take hold. You're seeing more people on the streets, more stores open, more activity. And again, I think that this is the natural healing process, and this is the move back to normalization of an economy. And to that point, I think that we have plenty of room to continue to grow. I think that we'll continue to see some pretty strong growth numbers as we move forward. And I think what you're also looking at is, I think for a lot of people, they're trying to really assess what does normal look like, what does the past data look like. And as we've talked about a lot of times, we need to not necessarily always look backward, but we do need to look forward and try to make an accurate assessment of what is the forward-looking picture. And as the vaccines continue to permeate through the world, it's not just in the United States, but we're starting to see a little bit of a reopening and a recovery trade in Europe. We're starting to see bond markets in Europe getting back to, almost positive territory in the German 10-year bunds, which is an important level. We're starting to see economic activity pick up. And, again, I think even just watching some of the sporting events right now as we go into the NBA and the NHL playoffs, watching full arenas, seeing people, without masks who are vaccinated going back and enjoying and celebrating life, I think that there's a lot of room for optimism that should continue as we, move through the rest of the year, particularly if the Fed is keeping a very tight lid and a very close eye on, what's happening with inflation and inflation expectations.
So basically what you're saying is that we shouldn't worry. We shouldn't let the media whip us into a frenzy right now. We should wait and see.
I think that's always a good policy, regardless of what the story is.
Absolutely. Again, don't let the media whip you into a frenzy. Michael Zaremsky, head of U.S. Private Bank Luma USA, member of the Investment Committee for Luma Investment Services. Thank you, and look forward to speaking with you again.
Thank you very much, Zev. Have a great day, and thanks for having me.
And we're going to be right back.